The Fed raised the federal funds rate by 75 basis points due to the previous 8.6 CPI report on Friday. This is the largest increase since 1994. The Atlanta Fed revised down their GDP now to 0.0%, signaling we may technically be heading into recession. Mortgage rates have risen above 6.28%. And to make matters worse, mortgage-backed securities went no bid on Friday after a surging inflation report leading to a similar predicament the MBS market experienced in 2008. Potentially breaking the mortgage-backed securities market and possibly taking the housing market with it. Hello, ladies and gentlemen. I hope you're all doing well. Welcome to the channel. Today we're going to cover breaking news from Zero Hedge, the Federal Reserve Bank of Atlanta, the National Association of Home Builders, Forbes, and much more. There's so much information to unpack here. Thank you so much for tuning in. One caveat: I am a Florida, Georgia real estate broker, not a financial advisor. All right, let's begin. Okay, so we have breaking news from the National Association of Home Builders. Weakening builder confidence points to economic troubles ahead. Rising inflation and higher mortgage rates are slowing traffic of prospective home buyers and putting a damper on builder sentiment. In a troubling sign for the housing market, builder confidence in the market for newly built single-family homes posted its sixth straight monthly decline in June, falling 2 points to 67 according to the National Association of Home Builders' Wells Fargo Housing Market Index, HMI, released today. This marks the lowest HMI reading since June 2020. So builder confidence in the market for newly built single-family homes posted its sixth straight monthly decline in June, according to the National Association of Home Builders. This is due to higher mortgage rates and inflation. Housing market in free fall as new construction plummets. New housing starts unexpectedly plunged more than economists projected, and for the second straight month in May, according to data released Thursday, adding to signs of an abrupt turnaround in the booming housing market. The number of housing starts, or new houses on which construction started, plunged 14.4% to about 1.5 million last month from 1.8 million in April, sharply below economic projections calling for nearly 1.7 million starts, the Census Bureau reported Thursday. Building permits also fell more than expected, coming in at less than 1.7 million in May, despite expectations they would remain roughly flat from April at roughly 1.8 million. In emailed comments Thursday, Pantheon Micro chief economist Ian Shepherdson attributed the sharper-than-expected decline to an abrupt, rapid drop in new home sales facing builders who overbuilt since early 2021 to capitalize on demand that's now in freefall and must slow construction to prevent a big hit to profits. The Fed's Wednesday rate hike is likely to accelerate the slowing of the housing market and eliminate construction jobs, says Macy McCain, chief investment officer at Texas-based Frost Investment Advisors. We'll be watching job openings and layoffs closely as the Fed continues to tighten into the slowing economy. Powell yesterday said the housing market is undergoing a reset, but it's much more than that, says Shepherdson, referring to the comments Powell made after instituting the largest interest rate hike in 28 years on Wednesday. Mortgages surged past 6% and hit their highest level since 2008. Housing market could torpedo U.S. economy, expert warns. Mortgage rates have surged higher this week as markets digest more aggressive interest rate hikes from the Federal Reserve, and with the average 30-year fixed mortgage rate hitting its highest level since 2008, experts warn that the warning signs in the housing market could spell trouble for the broader economy. Today's housing bubble is the Achilles heel that could put a torpedo into the side of the U.S. economy, especially as metrics such as home builder confidence and traffic of prospective buyers continue to plunge, predicts James Stack, president of Investatech Research and Stack Financial Management. New data on Wednesday from the National Association of Home Builders showed that home builder confidence declined for 6 months in a row, falling to its lowest level in 2 years as surging inflation and high mortgage rates priced buyers out of the market. And it goes on to say, the average interest rate on the popular 30-year fixed mortgage home loan now sits at over 6.2%. It's the highest level since the 2008 financial crisis and up from around 5.5% a week ago. Existing home sales and mortgage applications have both taken a hit amid rising interest rates and looming recession fears as the median monthly payment on a new 30-year mortgage rose more than 50% since last year, according to strategists at Goldman Sachs. We have new revised data from the Federal Reserve Bank of Atlanta. The GDP Now model estimate for the real GDP growth seasonally adjusted annual rate in the second quarter of 2022 is 0.0% on June 16th, unchanged from June 15th at the rounding. The Atlanta Fed revised down their GDP Now estimate to 0.0% from 0.9%. This puts the U.S. economy technically in recession. Retail sales posted an unexpected 0.3% decline in May as inflation hammers consumers. Retail and food service spending posted a surprise 0.3% decline in May, below the estimate for a 0.1% increase. Spending at gas stations led but was offset by declines elsewhere, according to numbers that are not adjusted for inflation. Retail sales turned negative in May, not adjusted for inflation, which increased 1% for the month. Plus, high gas prices coupled with high prices has led to less spending. Retail sales coupled with Atlanta Fed's estimate GDP now is signaling a possible recession as early as July, though not officially. As MBS go, no bid. Veteran mortgage broker warns nobody's prepared to deal with inflation. The CPI news this morning was so awful that it changed the bond market's view of the Fed's trajectory and the weakest sector broke. In bond jargon, MBS went no bid. No buyers for MBS. Then a few posted prices beyond borrower demand, not wanting to buy except at penalty prices. Overnight, the retail consequences has been leaped from roughly 5.5% to 6% for low-fee 30-fix loans. July 2007, you had to be deep in the mortgage racket to understand the first collision. Subprime and jumbos went no bid and stayed there. The Fed was slow to understand the credit panic and began frantic cuts the following winter from 5.25% to 2%. But mortgages did not respond and stuck above 6%. July 2008, the no bid expanded to all mortgages, even government guaranteed. The 10-year T-note anticipated recession and worse fell to 3.50, while retail mortgages rose to 7%. That 350 basis point spread is the closest comparable to today's 300 basis points. And it goes on to say, so now what? At Thanksgiving 2008, the credit markets, all markets, were rescued by Ben Bernanke's genius announcing quantitative easing, buying enough MBS and treasuries to unlock markets in which all had been afraid to buy. Today, it is a coincidence that the MBS had been blown simultaneously with the Fed's flip from QE buying to allow runoff and threatening to sell. The weak break first. MBS are weird, and the weird under stress is weak. The Fed has had a plan, Powell became more concise each day. We will raise the cost of money until inflation comes under control. It is our job to collaborate demand to supply, a good, tidy sort of mathematic way to proceed, but destruction of demand has limits, and this morning we hit one. Now, I know this is hard to follow, but basically mortgage-backed securities went no bid on Friday after a surging inflation report. This happened as the Fed begins quantitative tightening, putting pressure on the Fed's trajectory to unwind their balance sheet. This is very similar to what happened in 2007 and 2008 when the Fed began purchasing mortgage-backed securities with quantitative easing. This could be a potential crack in the mortgage market as the Fed continues to raise rates. It eventually led to the 2008 mortgage market meltdown. Unless the Fed can convince the mortgage market it can tame inflation, it may wind up breaking it. Do you think we're in the wake of a housing collapse? Let us know in the comments. Okay, so today's takeaway. The Fed raised the federal funds rate by 75 basis points in order to achieve maximum employment and inflation at the rate of 2% over the longer run. The Atlanta Fed revised down their GDP now estimate to 0.0% from 0.9%. This puts the U.S. economy technically in recession. Retail sales were also down 0.3% as inflation slams consumers. Housing starts are down 1.549 million from the expected 1.693 million. Permits were also down 1.695 million from an expected 1.778 million, according to the U.S. Census Bureau. And finally, mortgage-backed securities went no bid after a surging inflation report. Consequently, this occurred as the Fed begins quantitative tightening, putting pressure on the Fed's trajectory to unwind their balance sheet. And unless the Fed can convince the mortgage market it can tame inflation, it may wind up breaking it. If you like this video, please consider subscribing to the channel and hit that like button. I am a Florida, Georgia real estate broker, not a financial advisor. Thanks again, we'll see you in the next video.